are 10 minutes remaining in today's trading session. Joining us to help break down today's action, our guest lineup includes trader Michael Gurka of Empower Global Funds, standing by live at the Chicago Mercantile Exchange. And our featured guest is Jeremy Siegel, finance professor at the University of Pennsylvania's Wharton School. Professor Siegel, let's kick things off with you. We've got stocks on track for another down week. What do you make of kind of the recent pullback we've seen in the equity trade?
Well, I think it started when Obama started using the banking system as a scapegoat for the Democratic loss in Massachusetts. The words became much tougher. New regulations, new taxes, clawbacks, restrictions on banking. Because the economic news certainly has not been bad. You can't attribute anything going on in the economy to the pullback. Then again, you know, we've had several such 5 to 10% pullbacks since the March low, and at least at this point, this is shaping up as looking as one of those. It
sounds like you think the president's wrong in his pursuit of the banks. Am I reading it wrong?
Yeah, I mean, these restrictions on banking, he is not attacking what the cause of the crisis was. None of the restrictions that he's putting on had anything to do with the crisis. You know, proprietary trading, equity investing, hedge funds. That was not it. It was bad loans that were made in the real estate area on leveraged money. I'm not going to take the blame off the private sector. They were certainly contributing to that, but the Obama measures would have done absolutely nothing to prevent that problem.
Let me bring in Michael Gurka here. And Michael, I want to ask you, because you're down there in the heat of things trading stocks, why do we see such big drops when a lot of people are saying, hey, it was just a populist measure, that it's really just jawboning, and there's no way these kind of aggressive regulatory policies are going to pass through Congress anyway?
Well, first of all, let's take a look at what happened this week. This was a really big week on the calendar for banks. I mean, we knew the grilling was going to be there, and we clearly knew which way the arrow was going to be pointed from Washington. So midweek, my focus was that these bank stocks, if they can recover just on a weekly basis from where they started, I saw the S&P well above 1,100. I thought it was going to be, you know, rip roaring. Not to say that that was my expectation. I thought what we were going to see is exactly what unfolded. Somebody's going to get slapped on the hands here with the ruler, and we knew who it was. And for that, I'm not surprised. Now, just for a second here, 1087 was a big level for me in the S&P on a retracement, and it looks like we're not going to settle above that level. So there is this dynamic that we could start seeing a little bit of a bearish scenario as we start February. But more importantly, I'm watching the dollar, because really what happens to me is there's influences in Washington, clearly the dynamic of how this market is forward thinking. So we were expecting it to be a struggle as we close the week, even with these numbers that we saw today. And I think what happens here is now the dollar picks up some steam. The euro and the British pound in particular are really starting to see a little bit of a leveling off at some key support levels. And that is a recipe, I think, for watching energy prices maybe come off also. So we're getting this kind of fundamental scenario that we didn't have a year ago, where fixed income's up, equities are down, and vice versa with the dollar. So as traders, we like this. We don't always think it proportionally is going to mean one fits into the other. But I will say this, that right now at least, February could start off on a bearish note, and it actually could get a little uglier if we don't see a turnaround. But we knew the president was going to do this and hold someone accountable. And much like just mentioned, I don't agree with those measures, but, you know, we're not in the business of fighting it. We're in the business of trading it.
Jeremy, I actually want to get back to you. So in terms of everything, we got so much news out of Washington, State of the Union. Last week, you had the president talking big on banks. I mean, you know, we talked so much last year about climbing this wall of worry. Are we creating another wall in your view?
Well, in some extent, yes. I mean, I agree. There's a lot of talk. There's probably less likelihood that some of this is going to get through the Senate now than there was when the Democrats had an even 60. I think it's just the tone that's disturbing the market. And what Michael mentioned, I mean, the dollar, a strong dollar is good in the long run for the U.S., but it can give the stock market problems in the short run. And that strengthening dollar does make our exports less competitive, does lower the dollar value of revenues coming from abroad, the little bit of portfolio reallocation that comes. So some of the weakness is actually due to the short-term strength of the dollar. Now, the good aspect of that is bringing down oil. I'd love to see oil under 70. I was disturbed when it was 83. We get oil under 70, 65, bring those energy prices down. I think that'll be a base for another advance of the stock market.
I want to chime in here. It's Julie Hyman here because I want to talk about what we heard about in Davos today, and specifically from Duncan Niederauer, who is the head, of course, of NYSE Euronext. To get back to the prop trading question, he actually addressed that. So let's hear what he had to say in Davos. Well, I'll just have to tell you what he said in Davos. He said that the prop trading ban is not going to affect his business or will have a very small effect. So, Mike, let me ask you this first. What do you see? What's the talk sort of about what the effect of this could be?
Well, if you're talking about what the effect is on the prop side, you know, it's kind of like oil and vinegar. I mean, we need that interaction. There's nothing this market needed more a year ago than liquidity. And right now what happens is if these type of restrictions, at least according to me, if we see these kind of restrictions come into the marketplace and you can't have the big banks participating like they have historically, I think it's just going to get spread out into, you know, the private segment of who's trading and in the smaller shops. But at the same time, you know, there's a lot of good minds out there, and there's still going to be liquidity. So I don't see so much of an adverse effect, but what I do is see counterparty risk and some of the sorts of how these trades are going to get settled and balanced is going to be a key determinant. But just to go back to your last discussion, you know, if you want to look at the stock market as a pyramid, the banking sector is always going to be at the base because, again, so much depends on that flow. And when credit dried up, we saw the adverse effect of that. That being said, technology's up higher on that pyramid, and right now, at least, we need the market to feel as though that regulation is not going to put uncertainty into the marketplace because that's a bearish tone. With that being said, watch how this market reacts next week. I think if you start to see support hold in the marketplace, we're not going to be so much concerned about what we're speaking about right now, and I think that it's going to be attributed strictly to how China trades. And I think every day when I wake up, the day when Asia plays better, the markets help here also.
Jeremy, let me ask you, because if we get a positive print on next week's jobs report, do you start to feel even more confident about the outlook?
Well, we should. I mean, like today's report was good. In fact, all week we were getting some fairly good reports. We were getting very good earnings. The market was weak. It shows you the internal dynamics have turned weaker. But I absolutely agree. As usual, Friday's labor market report is going to be very key. We're all going to have all eyes on that. It's going to be the first real positive number, first report that I think we're going to have in a couple of years. We just inched a little positive on November, but it was originally reported as negative. We're going to be watching that. I think that's going to be really important.
Jeremy, let me ask you. Last time you were on with me and Carol, you said you did expect somewhat of a pullback, but I seem to remember that you expected it later on in the year. You still expect a pullback here? Is this it, or are we going to see another pullback before we get the 10 to 15% gain that you think we'll see?
I thought it was going to be. You're absolutely right. I thought it was going to be middle of the year when I thought the Fed were going to have to tighten earlier than what has been anticipated. I thought we were going to have a good January. It turned sour at the end with politics mixing in. This could be the sell-off. We haven't had a 10% correction. I think this is one of the longest bull markets in history where we haven't had a 10% correction now for a period of 10 months. It's very hard to know. You know, the behavior this week was not promising. I think we are going to get some selling into the early part of next week. This could hit a 10, 12% correction, but it's not a major end to the bull market. It was not a top in the middle of January. I feel confident that in the spring we're going to hit new highs.
All right. Hey, Jeremy, really appreciate you spending some time with us. Jeremy Siegel there joining us from the Wharton School. Michael Gurka, I want to say thank you to you as well.